Morning YouTube, this is the Working Investor. In this video we are going to talk about ULTY. ULTY's got some dividend payments coming out this week. Let's take another look at this fund. Let's look at this powerhouse sleeper, see what it's holding. Not financial advice, but we're just going to do a little deep dive and see why I'm very bullish on this ETF right now. So ULTY is the Yield Max Income ETF. They have a whopping distribution rate of 110+%. And the problem was that they have been going down until recently. They have been going down. See, if you zoom out, somebody who's looking into this fund start becoming flabbergasted seeing that the price dropped by 47%. But if you look a little bit closer in the last few months, you'll notice that something changed. It's not falling that quickly. Actually, I would say staying relatively flat. Of course, it does fluctuate because the products that it carries have a lot of implied volatility. The reason why they pay out so much is because they have a lot of implied volatility. And it's okay to have little fluctuations up and down in the underlying. I mean, that's people who buy into this asset need to be okay with that. But as long as it's relatively range bound, it is okay. And we're going to go into the holdings, and this has been this is how it used to always be: a payout and a steep drop, and it never ever recovers from that drop. But recently, from September all the way now till October, it's been pretty much staying, actually even August, I would say, from August all the way till now, I would say it's roughly range bound, as you can see. They are going to be changing they're going to have much more flexibility coming up really soon. I reckon around October 16th. That's what I hear. That's word from the fund managers. Around October 16th, they have SEC filing that they could do all kinds of interesting hedges and different strategies to protect the value of the stock price and still try to pay out a really good dividend. Again, this is not financial advice. I want to highlight, just going to look through the perspective. So what I attribute that the reason why it's been more flat is not, number one, how they're operating the fund, and number two, they've changed up their holdings. They do hold all kinds of stuff here. You could see a lot of interesting, very diversified with different sectors. It's not just tech, like for example, they have a bunch of like triple leverage funds in there, which triple leverage index funds like LabU is a triple leverage biotech fund. They have here, you can see the Pro Shares, the NASDAQ triple leverage fund. Here you got the Russell 2000 triple leverage fund. And let's just start breaking down a little bit. And you'll see here they have a bunch of underlyings that do have multiple different legs into the position. And a lot of the funds that YieldMax holds that are the highest dividend payers, like MicroStrategy, aka, they have their Misty fund, or Tesla or Tesla, or Coney. I'm not sure they have Coney right now. But anyways, let's get into some of these strategies, and we'll talk about their holdings and how they're running it. So let's look at this. If you go onto their website and you go onto holdings, I always recommend looking at it because it changes pretty often. It gives you an idea of what they're doing. So I bolded. You have MicroStrategy, and this is how many shares they have. They have, 105,000 shares of MicroStrategy. This looks like it's their entry price of how much they pay. They pay $212.59, and this is their market value. If you multiply 212.59 times 105,000, that's what it would be. And these are the options that they write against it. Now, I really encourage you to learn about options. If you're going to be investing in option-based ETFs, it's really important to have a good grasp on options and how they work and selling options, because that gives you an idea of what the fund is doing. Know your investments. So here you could see here that, remember, the cost basis is $212.59. So anything they sell a short call against that cost basis is, profit. So here they have below the cost basis a 195 strike price. This expires this coming week, right? And basically, yeah, this is how much they, here you go. So I'm assuming the negative 150 is how many contracts they have. And this looks like it's possibly how much premium they may have collected per contract. So remember, they collected over almost $21 in premium. So if you add, even though on first glance you're like, oh my God, they're selling it in the money call, but and if they get called away, if MicroStrategy is above this, it's a loss. Well, not necessarily, because their cost basis, let's say, is 212.59. But if they're receiving $20 in credit, that means if you take, so 202, 192. So they sell anything above 192, even though they're selling a 195, they would still have a net credit of, let's say, $3 per share, $3 per contract. $3 per share per contract. So it still would be a net profit. Obviously, if MicroStrategy would go down, they actually would be able to keep fully of that $20 per contract. And here, so it's not, even though it's an in the money call, but the premium actually makes up for it. That's what I understand over here. Again, I may be wrong, but here you have a 200 strike price, and like I said, okay, it's in the money. But remember, if they're getting $17 in premium, so really their break-even price is about 217. So anything above, is, they, even though they're, above the strike price, they still have a net of $5 per contract. And here you have the 210. Yes, they're $2.59 in the money, but their break even, they're making $11 on per contract. So really their break even is 20. They're anything above 212 is great. And yeah, they have a lot of buffer. So there's a lot of premium that they're getting in this. The negative, I believe, is a net, the positive is how much they paid. The negative is the credit. I know it sounds a little funny. So this is trying to break down what's happening with MicroStrategy. Here you got some NVIDIA. So again, I bolded like what they own. So NVIDIA, they have a cost basis of 134 $134.80. I'm sorry if I'm talking a little bit above you. If you don't understand a little bit of the options, I would ask you to go look more into it. This is a little bit more of an advanced play to understand this. So just remember, the 134 is the cost basis. So basically, what I'm trying to say is that, of course, if you sell a cover call below the cost basis, as long as the premium brings you back up to the cost basis and beyond, then it's a net positive, right? That's what I understand. So here you have a 132, so it's $2.80 in the money, but you're getting $4.50. So even though you're losing $2.80 in extrinsic value, you're making $4.50. You're still making money. You're still making money. It's still going to be net profit. So a lot of times with options, your risk analysis your is defined upon trade entry. When you do trade entry, that's when you define the risk parameters of your trade. So here you have, again, 134 is the cost basis. This is above the cost basis, 138, and they're making some, they're making some premium over there, and they sold a 140 call. Again, this is above their cost basis, so they're making, 86 cents per contract times 300 contracts. So they're making $25,800 on this trade. So you have an idea. I just want to give you guys an idea and a sense of, looking at their prospectus, looking at their holdings, and it gives you an idea of what's going on with the fund. And it's even more important to understand what you're holding, and especially after October 16, when they're going to be using all kinds of other strategies, maybe some collar method. And we're also going into earnings season. So, they did mention, Jay, the fund manager of VOMax, mentioned that there's so many interesting strategies that they could do and hedges they could do to protect your assets during or optimize or, return on earnings season. So this I just wanted to highlight over here. This is TNA, which is the triple leverage Russell 2000. So just to give you an example, so their entry point is 44.23. Interestingly enough, I actually have around that. That's pretty much my entry point, pretty much as well, and I am selling a covered call against it myself. And you can see here, 44.23 is their entry point. Yes, they're selling it in the money covered call, 43.50. So even though it's like almost like $1 in the money, but they're making $1.66. So I hope that you understand that even though they're in the money, that it looks like, oh my God, they're gonna have to get out of the trade if they get called away, with a net loss of extrinsic value. But they do have intrinsic value that makes up for it in their premium. Here we have Tesla. We'll just talk about Tesla. So I think they're gonna kill it over here. So here we have 217.8 is their cost basis, and they're selling a 240 strike price. I think Tesla's selling around, trading was, last I checked last night, it was like 219, somewhere in that range. So so yeah, so the 217 is their thing. They sold an out of the money covered call, so it's out of the money. It's above their cost basis. It's out of the money, and they received $4.15 per contract. They sold 340 contracts. They pretty much sold all the contracts against the the amount of shares they have. So they're making 400 so $4.15 per per share per contract. Anyways, yeah, just to give you guys a sense what's going on here with ULTY. Like I said, I think this could be really a sleeper. I'm really excited about this fund. Again, of course, not financial advice. You do take on a lot of risk. Please do your own research. Don't follow me. You need to do your own research. You need to consult the people you need to consult and make your own decisions. You are ultimately responsible for the decisions you make. This is the Working Investor over now.